Welcome to the deep dive. If you're busy, consider this your essential shortcut to the financial narratives driving the market.
That's right.
Today, we are tearing apart the Q3 2025 earnings call for the One Group Hospitality, ticker STKS.
Yep, STKS.
This call dropped after the market closed back on November 6th, and the volatility was immediate, and it was intense.
It really was. And we're diving into the financials of a truly complicated company here.
I mean, that's putting it mildly.
STKS is it's a highly leveraged multi-brand platform. And they're trying to execute one of the most ambitious transformations in the entire restaurant sector.
Absorbing that huge Benihana acquisition.
Exactly. All while the consumer is clearly pulling back because of all these macro headwinds. Our mission today is to figure out if their really aggressive strategic moves can possibly overcome the severe disappointment Q3 delivered.
Okay, so let's start with that headline shock. I mean, the top line figures immediately told the street there was trouble.
Big trouble.
GAAP revenue came in at $180.2 million. That missed the consensus of what, around $191 million?
Yeah, missed it by about 5.8%. And that's a significant miss for a company that is, frankly, relying on growth just to service its debt.
And if the revenue miss was troubling, the bottom line was, it was catastrophic on paper.
It was. Non-GAAP adjusted EPS was a loss of negative 66 cents a share. This was a colossal failure against a consensus loss of only 19 cents.
Wow.
That's a negative surprise of nearly 247%. Just a dramatic operational miss that sent the stock tumbling overnight.
But the number that really spooked the casual investor, I think, was that massive GAAP net loss, $85.3 million.
Which resulted in that disastrous negative $2.75 per share loss.
Right. But before anyone panics, we really have to break that number down.
That clarification is absolutely crucial. You have to do it to understand the real state of the business underneath.
Okay, so what's the story there?
Approximately $2.20 of that per share loss was non-cash. This wasn't money flying out the door for, wages or food costs. These were accounting adjustments.
And the bulk of that?
The bulk of it, about $64 million, was a significant tax valuation allowance.
Okay, can you elaborate on that? For listeners who, don't spend their weekends reading 10-Qs, what is a tax valuation allowance? Why does it inflate the loss so much?
So think of it as management cleaning house. They're admitting a hard reality.
Okay.
A tax valuation allowance is a non-cash reserve they have to record against these deferred tax assets they've built up. They now believe they won't be able to fully realize them in the future.
So they're basically saying they don't expect to be profitable enough soon enough to actually use all those tax benefits.
Precisely. It's a necessary accounting move to prepare the balance sheet for the future, but it just severely inflates the GAAP loss today.
And there were other charges too, right?
Right. We also saw about $3.4 million in impairment charges that was tied to them rationalizing their legacy grill locations.
So if you strip away the 80+ million in these paper losses, the operational pain is still there, but maybe it's not the existential threat that the headline number makes it seem like.
Exactly. It's bad, but it's not that bad.
Okay, so let's strip away that non-cash noise. Let's look at the core operational performance that genuinely concerned the market. What were the real weaknesses?
We saw, significant contraction, pretty much across the board. Consolidated comparable sales declined 5.9% year over year.
Ouch.
Management did point out one little silver lining, sequentially. Traffic did improve through the year. Q3 traffic was down 6.9%.
Which sounds bad.
It is, but it was their best traffic quarter of 2025. It was down 7.5% in Q2, so a slight improvement.
So they slowed the traffic bleeding a little bit, an operational positive, I guess. But it seems like that came at the immediate expense of their pricing power.
That's precisely what happened. Effective pricing just rolled off a cliff. Earlier in the year, they were getting almost a 7% pricing boost.
And in Q3.
Down to only 4%.
Yeah.
And that's because they started lapping the really aggressive price hikes they took the year before. So that combination, lower traffic and way less pricing power, it just hammered their margins. Adjusted EBITDA fell almost 29%.
And the actual restaurant level profit margin tells the same story, right?
Yeah.
Compressed from 12.8% down to 11.3%.
Yep. And management cited the standard trilogy of pain for that.
Mm-hmm.
Commodity inflation, higher marketing expenses, and critically, fixed cost deleveraging.
That's an important one. When your sales drop, your rent and utilities don't.
Exactly. Those fixed costs get spread across a much smaller revenue base, so they look proportionally way more expensive. The lower the sales, the more those fixed costs just bite into your profits. That's what we saw here.
They were also very specific about where the macro pain was concentrated. They called out California, Arizona, Florida, and Texas.
Yeah, and it seems to be both. High concentration of their restaurants and high pain in those markets. They have huge exposure in a place like California, which management specifically said saw pronounced softness.
How soft?
Sales sequentially, just between Q2 and Q3, deteriorated by 7 points in California alone. This severe traffic noise, especially in August and September, actually forced them to pause their pricing actions.
They just couldn't risk pushing prices any higher.
Not when traffic was already that fragile. The consumer was clearly retreating.
They also mentioned some issues in Las Vegas, which is a huge market for their STK brand, but they said convention scheduling was actually helping STK. Is that a real improvement or just a temporary blip?
That's the million-dollar question, isn't it? It's a mixed signal. They said the high-end STK business is improving there, mostly because of shifts in the convention calendar.
Some more group bookings.
Right. But, and this is a big but, they admitted their other more casual concepts in Vegas are not seeing that same lift.
So it's not a broad consumer recovery.
Not at all. It's very specific high-end group-driven revenue. If those convention cycles soften up next year, that STK improvement could just, evaporate.
Okay, so this massive contraction really forces the question, what is management's Hail Mary here? They're betting that aggressive strategic execution can outrun the macro storm and that debt load.
It's a big bet.
Let's get into that turnaround plan, starting with Benihana.
The Benihana integration is absolutely the core of their strategy. It's their future profit engine. They reported that the new Benihana prototype in Vienna, California, has been the best opening in the brand's entire 60-year history.
That's a huge claim.
It is. This new prototype, it has some strategic changes like moving the sushi station, expanding the bar, and it validates the potential for future units to hit $8 million in annual sales at mid 20% restaurant margins.
That's a powerful data point. But aren't we just relying on one single great opening in California while the rest of the portfolio is kind of struggling?
That is the risk. It absolutely is. But is also focusing on an operational lever that could impact every single existing Benihana at once.
And that is?
Table efficiency. This is their immediate capacity catalyst for Q4. Management is targeting a crucial reduction in Benihana's table turn times, from 120 minutes down to just 90 minutes.
Shaving 30 minutes off a teppanyaki table. That sounds kind of marginal. I mean, it's an experience, right? It takes time.
See, it sounds marginal, but it is transformational. It is not marginal at all. It's a 25% increase in your throughput capacity during peak hours.
25%.
If you can squeeze in one extra seating per table during a 4-hour dinner rush, say from 5 to 9 p.m., you significantly increase your total sales. And for a high-volume restaurant during the Q4 holidays, that translates directly into millions in revenue.
The millions they need to hit that aggressive guidance.
This is a key execution focus for them.
Okay, and at the same time, they're getting ruthless with the legacy portfolio, specifically the grill concepts.
Very ruthless. They closed 6 underperforming grill units, and now they're planning to convert up to 9 more of them into either STK or Benihana formats by the end of 2026.
That's a targeted capital strategy, but how are they funding this, given that huge debt load?
This is where the strategy looks surprisingly efficient. They said the conversion capex is very low, around $1 million per unit.
Wait, only $1 million per conversion with construction costs these days?
I know, it's highly efficient. They're leveraging the existing real estate and infrastructure, and they're expecting sub-1 year paybacks on that investment. These aren't ground-up rebuilds, they're high-return flips of underperforming assets.
Right. And then finally, their long-term growth story seems to be shifting away from owning venues to a more asset-light franchising model.
It is. And this is the real structural solution to their debt problem, long-term. Franchising momentum is picking up, especially with this new Benihana Express format.
That's the one that just opened in Miami, right?
The second one, yep. The Express format offers the full menu, but it doesn't have the really expensive teppanyaki setup, so the build-out cost is low, maybe $500,000 to $600,000.
And the margins for the franchisee?
They're projecting very high store-level margins, maybe 15 to 20%. Their long-term goal is to have franchised and licensed locations be over 60% of their total footprint.
So despite this absolutely catastrophic Q3, management reaffirmed their full year 2025 guidance.
They did, which signals, extreme confidence in their ability to execute this turnaround in Q4. They're sticking with revenue between 820 and 825 million and adjusted EBITDA between 95 and 100 million.
They're really banking on the holidays.
Completely. They stressed Q4 is always their strongest period. They have robust holiday bookings, and they've already layered in new price increases, a weighted average of 4.5% to 5.5% that started in November.
But that confidence exists against a very, very difficult balance sheet reality, one the market can't ignore.
And that reality is the core risk. They ended the quarter with 45 million in liquidity, which sounds okay, but the balance sheet is carrying over $600 million in debt.
So what's the leverage ratio?
Their net debt to EBITDA is near 7 times. And at 7x, they are highly, highly vulnerable to any operational hiccup or, any trouble in the debt markets. That leverage dictates their survival.
And that high leverage, plus the poor Q3, played right into the hands of the activists who are already circling.
Absolutely. Even before the call, the activist firm Randian Capital was publicly urging them to slow growth and pivot to franchising.
And after the stock slumped,
Randian escalated. They started publicly pushing for a Benihana IPO.
To unlock that value and generate cash to pay down the debt.
To get immediate cash to address that massive debt load. And analyst sentiment just reflected this risk. Zacks has a strong sell on it, pointing to the leverage, the execution risk, the negative comps. STKS has just materially underperformed everything.
Okay, so we've got management betting on a massive Q4 execution, but the market is just laser focused on the debt and these activist demands.
That's the core tension. A battle between operational potential and financial distress.
Okay, let's pivot to our final segment. And as always, a reminder, we are summarizers, not investment advisors. This is not financial advice.
Not financial advice.
But just for educational purposes, if you were a hedge fund analyst looking at this extreme contradictory mess, what's the most outrageous but plausible trade idea you'd pitch?
Given the depressed valuation and that activist catalyst, I would pitch what we could call the Randian hedge.
The Randian hedge.
The stock is trading near all-time lows. It's behaving like a distressed equity because of that $600 million in debt and the volatile legacy concept.
So the thesis is you're betting on the hidden value of Benihana being forced out while protecting yourself from the downside risk of the leverage.
Exactly. The thesis is the market is severely undervaluing the core Benihana brand, which management claims is outperforming and has massive asset-light franchise potential. The activist demand for a separation, an IPO or a spin-off, that's the primary catalyst.
So how do you structure that trade to protect against the ongoing risk?
The trade is built to be simultaneous. You go short STKS equity.
Okay, so you're betting that the debt and the macro pressures keep pushing the stock price down.
You're betting the market keeps punishing them and that the non-cash losses continue to spook retail investors. But you pair that by taking a long leverage position in out-of-the-money call options.
So that's the lottery ticket. You're buying the long shot on a specific corporate action.
That's it. You were betting on an imminent activist force separation of Benihana within, say, the next 12 months. If that happens, it would realize massive immediate cash for deleveraging.
And the stock would soar, making those cheap call options pay off huge.
Handsomely. It rewards the bet on strategic intervention overcoming the fundamental malaise.
So, to simplify, you're shorting the messy past and the current debt, but you're simultaneously buying the clean, high-growth, separated future of Benihana through options. That is the definition of a high-risk, high-reward bet.
It perfectly captures the contradictory signals in the market right now.
Okay, to quickly recap this deep dive, the One Group Hospitality dropped Q3 numbers defined by a deep GAAP loss, which masked some sequential traffic improvements. Strategically, management is aggressive. They're rationalizing the grill portfolio, leaning hard into the Benihana Express model, all while trying to shave 30 minutes off every teppanyaki table turn.
But all of this strategic effort is happening against a backdrop of crushing debt and increasing activist demands for a Benihana separation.
So the crucial question for you, the informed observer, remains.
Given management's aggressive focus on maximizing capacity with those 90-minute table turns and their total reliance on Q4 to hit that guidance, Will the market finally reward execution in the next print? Will they start focusing on the long-term Benihana story, or is that extreme 7x leverage simply too high of a hurdle to overcome in this environment?
We will find out next quarter. Thanks for joining us for this essential summary. Remember, all information presented here is for informational purposes only. Do your own due diligence.
Absolutely.
We'll catch you on the next deep dive.